What is good, boys and girls? Just got a very good video today for you guys on the power of three and standard deviation and combining the two together so you can see where the power of three is going to end. So firstly, what is the power of three? Just a little refresher if you do know it, and if you don't know it, then listen up. Firstly, we have our accumulation, which is essentially price moving in a very tight range, equal highs, equal lows, disrespecting PDRAs on both sides of the market. We don't want to trade this at all, so we steer clear of that. And now for the manipulation, it is a sharp move out of the range, and most of the time it will tap into a higher time frame PDRA like an FEG or even just any form of liquidity in general. This is going to be a bullish power of three that I'm doing, so we will manipulate lower so we can go higher. If it were to be a bearish power of three, we would manipulate higher to continue lower. So we get our manipulation, then we get our distribution, and that is the power of three cycle finished. Okay, that's a power of three done. I'm sure you will know what that is if you're trying to learn this, and I'll get into the standard deviation aspect of it now and how we can gauge where exactly we're going to get the reversal. Where do we anchor / draw our standard deviation tool? On the nearest manipulation leg before we broke structure. And I'll get into some real chart examples after this, of course, so you can all understand this in the real setting, not just in theory. That's essentially it. Always the manipulation leg before we started distributing. So how exactly do we know what a manipulation leg is instead of just another pullback? It's simple. When you see a manipulation leg, we will always come and break structure like this, break of structure there, then you would see immediate displacement back up, and then we will break structure again up here. So this would be what a manipulation leg is. And for drawing your standard deviation, as this is a bearish manipulation, we will anchor our standard deviation from the low to the high. And for a bullish manipulation, you will anchor it from the top to the bottom. So why do I do it this way? Well, think about it logically. If we're going to continue lower, how exactly are we going to deliver to a negative standard deviation? That's why in this, I'm trading a reversal. So I would be trading the negative standard deviation. So this is how it would look in a perfect ideal scenario. You have your accumulation, then you manipulate lower, break structure, tap into a higher time frame PDRA, and then you can draw your standard deviation like this, and then we distribute higher, and we will come back up into one of these levels. And here are my standard deviation settings. I do use these, and I also do use the negative 3.5 sometimes. If we're dealing in a very large range, I will use the negative 3.5, but if it is a smaller range, I will stick to these. So you know how to anchor your standard deviation, but how will we know which level is actually going to hold, and how do we get high probability trades out of it? So a high probability level will always have a PDRA aligned with it. I'm sure you know what PDRAs are, but it includes stuff like FEGs and order blocks. So for an ideal scenario, we will get our accumulation, then we will manipulate lower, break structure, and now we see a displacement and a further break of structure here. Then we can look for a PDRA such as an FEG or order block. So let's just say this is what the manipulation look like. And we've anchored our standard deviation from the low to the high, and we have our -2 standard deviation aligning with this level. You can either set it at the standard deviation level with your stops outside of the standard deviations, but what I like to do is I wait for a displacement or a nice 30-second closure, and I'll show you a really nice example of something that played out the other day, and it was just so perfect. Everything that I'm talking about now, it's literally like that on the chart. So I'll hop straight into it right now and show you guys. Okay, so here's our example. As you can see, clean accumulation range with a sharp move out of the range to sweep this liquidity and break structure. So now we can wait to see if this is the actual manipulation leg, which yes, it is. We just broke structure below this swing low. Now we can anchor our standard deviation as it is a bullish manipulation from the top of the swing to the low of the swing, which would be here and not here, because you can see we had this up close candle, meaning that this is one swing and this is another swing. Now we can watch our standard deviation levels and see, do we have any PDRAs aligned? And wow, very nice PDRA here, unmitigated 15-minute gap, and and it aligns with these levels. I'm going to completely disregard these levels for this trade because we don't have anything overlapping, just a bunch of accumulation and this swing low. Let's keep an eye on these levels here and see if we get a reaction. Okay, so now we're starting to get into the juicy part. Let's see if we can get a good candle closure and a good rejection off one of these levels. And honestly, that would be enough for an entry for me personally. So I would go ahead, enter there with stops just outside that swing and target the main reversion, which is the 0.5, or you could even target the accumulation highs. And this trade, I took this with quarterly theory. I'm not sure if you've watched my quarterly theory video, but I'm just going to show you here. This was clean AMD profile with the second quarter manipulating. Standard deviation plus quarterly theory is literally just too overpowered. I need to gatekeep that. No, I'm joking. I'll make a video on it soon for you guys, but let's just see how this would have played out. Like, come on. Like, you could have even taken this bottom tick right here. You would have been able to get away with a 5-point stop. But obviously, hindsight, if I were to trade this, I would have looked for this 3.5 or this -4, as that is closest to the CE of the gap, which again, you would have been able to do, but you would have left your stop outside of the -4.5 and you would have got wicked out. So that is why I recommend you wait for a bullish candle closure or even something like 30-second inversion. I remember there was a 30-second inversion here. I also have a proper entry model on my channel for the power of 3 and standard deviation with the daily profiles. So go ahead and watch that if you haven't already. And I also have a quarterly theory video, which is literally one of the main confluences in this trade apart from standard deviation. Hope you guys enjoy your day. Hope you guys enjoyed the video, and I'll catch you in the next one. Peace.